You think your stop loss is protecting you, right? Wrong. Every trader sets one, convinced they're playing defense. But here's the brutal truth. Your stop loss might be the exact reason you keep bleeding money. We've all been there. You place a stop at what feels safe, then watch in horror as the market perfectly tags your level, sometimes to the tick, before rocketing in your original direction. The problem isn't your technical analysis or your entry. The real issue is that you're placing your stop for the wrong reason, and the market knows exactly what you're thinking. Most traders ask, how much am I willing to lose, instead of, where is my trade idea proven wrong? This backward thinking turns your protective tool into a precision-guided wealth destroyer. Ready to flip the script? Your stop loss needs to tell a story about market structure, not the size of your fear. I'm going to show you the 5 deadly sins of stop losses that every struggling trader commits. And stick with me, because at the end, I'm going to reveal the one critical piece of information that separates the 95% who fail from the 5% who get funded. This could change everything. Section 1. The Great Deception. Why your stop loss is failing you. For years, I was disciplined. I put a stop loss on every single trade. It's your insurance policy, right? But what if that insurance was secretly designed to fail? Most traders who blow accounts don't fail because they chose the wrong direction. They fail because of where they put their stop loss. This isn't a new idea. The legendary trader Richard Wyckoff was writing about this over a century ago. You might think your simulated prop firm account is separate from the real market, but it just copies a world where stop-loss hunts are a daily reality. Big banks and institutions don't need to see your individual stop. They just know where millions of retail traders are taught to place them. Right below support, right above resistance, or near a big, round number. These obvious spots create massive pools of orders. Institutions can push the price just enough to trigger that flood of stops, giving them the liquidity to fill their own enormous positions at a better price. The result? Your stop gets hit, the price reverses, and then flies in your original direction. You weren't wrong about the trade, you were wrong about the game. You placed your stop in an obvious spot and became collateral damage. Section 2. The 5 deadly sins of stop losses. Number 1. The sin of hope, trading without any stop loss. This is the trader who refuses to place a stop muttering, "It'll come back." That's not a strategy, it's a prayer. And hope is the most expensive liability in trading. As Wyckoff said, this is like owning a house without fire insurance. You might be fine for years, but one fire will burn it all to the ground. A stop loss isn't a sign of weakness. It's a non-negotiable business expense. It's the tool that guarantees one bad trade can't end your career. Refusing to use one is just your ego writing checks your account can't cash. Number 2. The sin of rigidity. Using arbitrary percentage-based stops. This happens when you try to force your will on the market. A trader declares, "I risk exactly 1% on every trade." It sounds disciplined, but it completely ignores market behavior. The market doesn't care about your 1% rule. A volatile market needs more room to breathe. A 1% stop will get clipped by normal price fluctuations. In a slow-moving market, a 1% stop might be too far away. Your risk plan is critical, but it cannot be the sole factor that determines your stop placement. Your stop loss should not be based on what you can lose. It must be placed at the exact price that proves your trade idea was fundamentally wrong. If you bought because the price bounced off a key level, your stop goes below that level. If it breaks, your trade is invalid. It's that simple. Number 3. The sin of denial. Moving your stop loss to avoid a loss. This is the single most destructive sin in a prop firm challenge. You're in a trade, it moves against you, and panic sets in. You can't stand the thought of taking the loss, so you justify it. "I'll just give it a little more room." You drag your stop further down, turning a small, manageable loss into a catastrophic one that hits your drawdown. It's pure denial. The only time you should ever move a stop is to lock in profits. Moving a stop further away from your entry is you screaming at the market, "I know I'm wrong, but I'm willing to be even more wrong." An experienced trader accepts the small loss and moves on. An amateur marries the trade and blows their account. Number 4. The sin of fear. Placing your stop loss too close. After a string of losses, it's natural to get scared. This fear leads to the 4th sin, placing your stops far too close to your entry. You think you're minimizing risk, but you're actually maximizing your odds of getting stopped out by random market noise. This is death by 1,000 cuts. Markets don't move in straight lines. They ebb and flow. These fluctuations are healthy price action. But with a tight stop, you get shaken out of a potentially great trade just moments before it takes off. This is the hunting ground for institutional players. They know scared traders place their stops in obvious, tight spots. They push the price just enough to grab that liquidity before sending it right where you predicted it would go. Trying to be extra safe just made you an easy target. Number 5. The sin of impulse. Failing to trail your stop correctly. The final sin is a toxic cocktail of fear and greed that ruins your winning trades. On one hand, you have the fearful trader who snatches a tiny profit, terrified it will turn into a loss. On the other, you have the greedy trader who rides a winner all the way up and then all the way back down to zero. An experienced trader uses a trailing stop, but they move it based on market structure, not emotion. In a clear uptrend, after the price makes a new high and then forms a new higher low, you move your stop just below that new low. You repeat this process as the trend continues. Your stop only gets hit when the trend structure is actually broken. This removes emotion and lets the market tell you when the party's over. If any of these sins sound painfully familiar, good news. There's a cure, and we know the secret. So keep watching, hit that subscribe button, and don't miss what's coming. When you're ready for your next account, use code FFF at our preferred prop firms for the best discount. All the links are waiting for you in the description below. Section 3. The Path to Redemption. I know exactly how it feels. You spend hours studying charts, you execute your trade, and you still get kicked out right before the real move happens. It feels personal, like the market has a vendetta against you. But the truth is, you're just making predictable and fixable mistakes. You don't need a fancier indicator or secret strategy. You need a fundamental shift in how you think about your stops. If you're new to trading, the conflicting advice is overwhelming. Some say use tight stops. Others say use wide ones. It's enough to make your head spin. So how do we fix this? It comes down to a simple 3-step process you must follow before every single trade. First, define your why. Before you risk a single dollar, state in one simple sentence why you are entering this trade. Is it a breakout above resistance? A bounce off a demand zone? That reason is the entire foundation of your trade. Second, find your invalidation. Now ask the most important question. At what exact price is my reason for entering 100% wrong? Not where it feels uncomfortable, but where the setup is completely busted. That is where your stop loss goes. It's defined by the market, not a random percentage. Third, do the math. Now that you have your entry and your invalidation point, you know your precise risk. Look at the chart and identify a logical profit target. If your potential reward doesn't outweigh your risk, don't take that trade. And if the required stop loss is too large for your prop firm's daily loss limit, wait for a higher quality setup. Period. Let me make this simple. Trust what the chart is showing you. Institutional money moves markets in observable patterns. Place your stops where these patterns tell you your idea is wrong, not where a risk calculator tells you to. Look at your losing trades with brutal honesty. Ask yourself, did I place my stop where everyone else would? Was my stop too tight because I was scared? Did I enter before the market actually confirmed my idea? Most losses stem from these reasons. Once you see the pattern, you can break it. Start placing your stops beyond the obvious levels where weak hands get shaken out. Give your trades room to breathe based on the market's normal volatility. This is your path forward. Think differently from the crowd. Stay disciplined when others panic. Act logically when others act on emotion. The market rewards those who see what others miss. Imagine yourself a year from now, placing intelligent stops, letting your trades work, and watching your account grow steadily. Not from a magic formula, but from finally eliminating your own mistakes. Your stop loss says everything about you as a trader. Beginning traders place them based on fear, hope, and arbitrary rules. Experienced traders place them based on a clear, logical invalidation of their trade idea. They treat small losses as the cost of doing business, which allows them to stay in the game long enough to capture the massive winners. Stop being the fuel for the market. Start thinking like the people who run it. Want to know what separates consistent traders from everyone else? It's not their strategy, it's their mindset. Watch our video, What Winning Traders Know That You Don't, next, and make that shift for yourself.